Hello and welcome to Genius Indian. Friends, during February 2020, the stock markets around the globe fell due to the spread of coronavirus. From third week of February, when Dow Jones was at 29,200 levels, it fell all the way to 18,200 levels by third week of March. Mirroring the Dow Jones, our own NIFTY also fell from almost 12,000 level to 7,500 level during the same period. And in the process, it wiped out lakhs of crores of investor wealth as well as all the gains recorded during past 5 years. The magnitude of the fall surprised most investors. Some called it unprecedented, and they were not wrong. After all, in modern times, such a fall has been quite unparalleled. But if we travel 100 years back in time, then we will realize that Dow Jones has witnessed much worse times. That's right, I am talking about the Wall Street crash of 1929, the crash that led to the Great Depression, the crash that made 1 out of every 4 Americans jobless, the crash that reduced the average family income by a whopping 40%, and the crash that chopped off the gross national product of the United States by 50%. But before we examine the crash, let us look at the reasons which led to that crash. And the chief reasons were overproduction of goods, stock speculation, consumer debt, and bank failures. And all these can be attributed to the good times that rolled in after the end of the First World War. The end of the Great War infused a new lease of life into the American economy. New railroads were laid everywhere and highways were built from one end of the country to another. A whole lot of farm machinery was produced, which increased the agricultural output. Bumper crops meant overproduction, as a result of which thousands of farmers could migrate to the cities. More workers in the cities fueled more industries, as a result of which the industrial output also increased. Industries produced consumer goods like gyrator washing machines, waffle irons, and deep freezers. Electrification was already changing American cities and homes. Radios, aeroplanes, and vacuum cleaners were becoming commonplace, and a whole lot of people were driving Ford cars. People were buying cars and home improvement appliances. Those who had money bought more stuff than they needed. Those who did not have the money bought it through the credit. Old conservative mentality of buying only when you have the money was happily discarded, and buying on credit was not considered a sin anymore. Buy right now, pay later was treated as the new mantra for a happy life. All this industrial and commercial activity began pushing the stock prices up. Wall Street became a happy place, and soon the retail investors began buying shares. At first, they bought it with their cash, but gradually, brokers and banks began funding them to buy on margin. As a result of which, any investor could buy $100 worth of stocks with just $10 in his pocket. Since the market kept going up and up, nobody bothered. And looking at the success of early investors and looking at the stability of the market, every day more and more new investors entered the market. Everybody was in love with their stocks. By mid-20s, about 30 lakh Americans were actively participating in Wall Street activities, directly and indirectly. Winston Churchill, the future Prime Minister of Britain, Groucho Marx, and a string of Hollywood stars, everybody was investing in stocks. Economist Irving Fisher was so confident of the rising stocks that he proclaimed stock prices have reached what looks like a permanently high plateau. Not surprising, the latest Wall Street share prices were displayed not only in beauty parlors but also in places like nightclubs. By September 1929, the market had been on a 9-year run that saw Dow Jones Industrial Average increase in value tenfold. Dow peaked at 381.17 on 3rd September 1929. And from here, things went shaky. The shares began falling on 23rd October. On 24th October, which was later on called Black Tuesday, the market lost 11% of its value at the opening bell on very heavy trading. In those days, there were no computers, and the prices of shares traded on stock market floor were manually fed on the ticker tape. But the huge volume of shares sold that day meant that the report of prices on the ticker tape in brokerage offices around the nation was many hours late, and as a result of which investors had no idea of the prices of most stocks being traded at the moment, and this increased the panic-driven selling. Several leading Wall Street bankers met to find a solution to the panic and chaos on the trading floor. Bankers from JP Morgan, Chase National Bank, and Citibank got together and decided to support the market, and they purchased lots of shares. On 28th October or Black Monday, more investors sold their shares to get out of the market, as a result of which the Dow Jones lost 38 points, which amounted to 13% fall. As a result of this unprecedented fall, large crowds gathered outside the stock exchange building. On 29th October, William C. Durant joined hands with the members of Rockefeller family, as well as other financial giants, to buy large quantities of stocks simply to demonstrate to the public their confidence in the market. But even their efforts failed to stop the large decline in the prices. In spite of their bulk purchases, panic selling reached its peak and about 16 million shares were traded. The panic was so intense that some stocks had simply no buyers at any price that day, as a result of which the Dow Jones lost an additional 30 points or 12%, a reason why it came to be known as Black Tuesday. The volume of stocks traded on that day was a record that would not be broken for nearly 40 years. The massive volume of stocks traded on that day made the ticker continue to run until about 7:45 p.m. The market had lost over $30 billion in the space of 2 days, including $14 billion on October 29. But the meltdown did not stop there. The Dow continued a steady slide from there till 8th July 1932, when it closed at 41.22, which happens to be its lowest level during the 20th century, which also meant that it had fallen a massive 89% compared to the peak of the market. And while the fall from 381 to 41 took less than 3 years, it took Dow Jones next 25 years to climb back to the same 381 level, which it finally did on 23rd November 1954. And the Great Depression lasted all the way till the beginning of the Second World War. During this period, bankruptcies and severe macroeconomic difficulties became routine. Contraction of credit, business closures, firing of workers, bank failures, decline of the money supply, and other economically depressing events became common. In 1 year alone, more than 2,000 banks went down with nearly $1.7 billion in deposits. Around 300,000 companies went out of business. Some 4,000 banks and other lenders ultimately failed. The decline in stock prices caused massive strife among the Americans. In 1929, the unemployment rate was around 3%, but by 1933, it had climbed to 25%. Hundreds of thousands of families could not pay their mortgages and were evicted from their homes. Thousands slept on newspapers. Thousands ate only the meals available at the soup kitchens, and thousands lived in shanties. And nearly 50% of all the children during the Great Depression did not have adequate food, shelter, or medical care. So friends, this was a brief intro to the Wall Street crash of 1929. In the next episode, I will be discussing some other topic, a topic that improves our understanding of the world, and a topic that helps us realize our true potential. So please don't miss it. And the best way not to miss it is to subscribe to Genius Indian channel. And the best way to spread this knowledge is to like and share the video. And the best way to help me improve the quality of my work is to provide your valuable feedback. And finally, the best way to end this conversation is to tell you thanks for watching.